Hello and welcome to the Global View on this Tuesday. I'm Andrew Geoghegan. Good to have you back with us here at Ospreys as we get across what happened on global markets overnight. Risk on, sentiment, that return, further fueling equity markets with Minsky's gauge of global stocks rising around 1%. Now on Wall Street, tech was back in favour following last week's AI-related sell-off, boosting the S&P and Nasdaq. Software companies continue to claw back losses with the S&P 500 Software Services Index up around 6%, but still some 13% adrift of its highs around 2 weeks ago. Oracle was among the best performers after a broker upgrade, while Microsoft has been downgraded to a hold by Melius Research, which says the company is moving too slowly on its Copilot 365. NVIDIA also gaining, while Google parent Alphabet planned sale of $15 billion of US dollar bonds drew more than $100 billion in orders. Among the other movers, Hims & Hers health shares sank after Novo Nordisk sued the telehealth firm for patent infringement after it launched then cancelled a copy of the Danish drug maker's weight loss pill. Workday shares slid after the human resources software provider announced co-founder Anil Bursari will return as chief executive. Apollo Global Management rose after the asset management reported a 13% increase in fourth quarter profit. Shares in IT services provider Kyndryl plummeted after the delay in its quarterly filing and flagged material weakness in financial reporting. And grocery giant Kroger gaining after it named former Walmart executive Greg Foran as its chief executive. Well, White House economic advisor Kevin Hassett has said the US job gains could be lower in the coming months due to slower labour force growth and higher productivity, saying, I think that you should expect slightly smaller job numbers that are consistent with high GDP growth right now. Population growth is going down and productivity growth is skyrocketing. Meanwhile, in the UK, Prime Minister Keir Starmer has resisted calls to quit, with the leader of his party in Scotland demanding he stand down as the fallout from Starmer's appointment of Peter Mandelson as US ambassador grows. Two of the Prime Minister's closest advisors have quit in recent days over the appointment of Mandelson, whose close ties to the late US sex offender Jeffrey Epstein has plunged the government into crisis. Bloomberg has reported that Chinese regulators have advised financial institutions to rein in their holdings of US Treasury bonds, citing concerns over concentration risks and market volatility. Well, the US 2-year Treasury yield has fallen to 3.48%, the 10-year at 4.2%. Australian 3-year government bond yields falling to 4.33%. The US dollar index is down more than 0.5% on the day. The yen strengthening after Japanese Prime Minister Sani Takaichi's resounding election victory. And the Aussie dollar is at 70.9 US cents. Well, oil prices have risen after the US Department of Transportation issued an advisory to US-flagged vessels to avoid Iranian territory while passing through the Strait of Hormuz and Gulf of Oman. Brent crude futures up more than 1.5% at $69 a barrel. Gold is up more than 2%, buoyed by a softer US dollar. Spot gold at around $5,080 an ounce. Spot silver up more than 7% to close to $84 an ounce. Copper high and iron ore trading at 101 US a ton. Bitcoin is trading above 70,000 US dollars. Let's now get across those market moves with a focus on Wall Street. Steve Sosnick joining us again from Interactive Brokers. Steve, welcome back. So, volatility has pretty much become a hallmark of this market, hasn't it?
Yeah, Andrew, it has, but it's a lot of churning of the gears really to not go anywhere. So, last week in the U.S., we had a 3% range in the S&P 500, a 5% range in the Nasdaq 100. But the S&P 500 last week closed down 7 points. So that's like 0.01% basically. So we barely moved after all the, in the long run, after all the big intraday moves. Today, we saw a bit more of a follow through than maybe some people were expecting. But even there, we didn't move too much intraday, but underlying this all, there are some huge moves in stocks, and you just outlined some of them. It's really not uncommon to see stocks moving double digits on any given day based on news. So under the surface, there's still a lot of turbulence, even if even if we remain calm relatively at the top.
Steve, do you feel as though this rotation out of tech still has legs? Certainly those in tech, those who favour it, are saying this has been way oversold.
Both can be true. You can be very oversold, but you could also see the rotation continuing. The rotation seems to be a bit of a secular trend where we're seeing people really rethink the idea of maybe not tech overall, but how they're invested in tech. We have seen semis do okay, not wonderfully overall, but in general, maybe certainly hardware over software. But I think also overall, we're seeing a bit more of a move into whether you want to call it value over growth, whether you want to call it low beta over higher beta, whether you want to call it dividend payers over non-dividend payers. The end result is we are seeing some big rotation. And even on some of the bigger down moves, we saw a lot of sectors doing okay. It's just the problem being that because tech is so heavily weighted in the major indices, if they're going down, it's really hard for all the others to pull up the weight that's required to offset a big move in tech.
Now, Stephen, investors also have a close eye on economic data, in particular jobs. Now, I just referenced those comments there from Kevin Hassett, who's essentially implying there's going to be greater pressure on jobs at the moment, particularly given those productivity gains you're seeing. What's your take on what you're seeing in that data? Of course, we're going to get the non-farm payrolls, which has been delayed later in the week.
Well, for a hot minute there this morning, we actually thought that he might know something and got worried, but then the markets, said, we'll worry about that tomorrow or Wednesday. The basic feeling is, we don't know what he knows, but there's certainly a bit of a grind in terms of lower jobless, lower job creation, higher continuing claims, lower job posting via JOLTS data, which fell kind of precipitously last week. Was the market again did worry about that there for a little bit. So we have to see the non-farm payroll numbers expected to be the consensus is 70,000 gained, and the unemployment rate's supposed to stay stable at 4.4%. In theory, that's pretty decent, actually. I mean, 4.4% historically is a very enviable number, and 70,000, while not being wonderful job growth, is enough to at least keep things moving. But the bigger worry there is once a year, the Bureau of Labor Statistics redoes its what they call the birth-death model. There's a certain amount of extrapolation that goes into the jobs numbers that we see every month, and because of the way the surveys are conducted, I don't, we could spend another half hour on that. I'm not going to, but what it means is once a year they revamp that, and the consensus estimate is that they're going to wipe 825,000 jobs or so off the ledger. That might surprise people a bit, and we'll really have to see. On the other hand, between 0 and 825,000 is a big gulf too. So there's a lot of room for that number to be better than expected. So that's really where the interest lies for Wednesday's report.
Now, Steve, beyond Wall Street, of course, we saw some very impressive gains yesterday, Monday, our time, particularly in the Asian session, with a focus on Japan, of course, in the wake of a resounding victory by the incumbent, the Prime Minister. Should we have been surprised by that? I mean, just before we came on there, you noted what we saw, particularly in the Tokyo Exchange there, and where those shares have gone to. And of course, also very much a focus on the yen, which has been under tremendous pressure, making a bit of a comeback.
Yeah, I think it was widely expected that what she did was took a big gamble, but the gamble paid off. That's great, and the market rewarded her for that. The interesting thing is that we'd seen the Japanese bond yields rise dramatically, which did put some pressure on global bond yields. And I think ultimately, if you do have Japanese bonds under severe pressure, that's not good for global bond markets. But it abated. There was, because there is a thought that she's going to try to lower consumption taxes, which raises the deficits, et cetera, et cetera. That then, in spite of the interest rate rises, put some pressure on the yen. So what we saw was actually in some ways, from the stock point of view, buy the rumor, buy the news. From the yen point of view, you might think that some of the higher rates would have helped the yen in of themselves, but what we saw was this big relief rally in yen without much of a consequential move in the bond market. So that all bodes pretty well, at least for sentiment in Japan. However, whether that can persist in the way that we want it to, need it to, if you're a Japanese investor, that remains to be seen. But certainly, the market is displaying a lot of confidence in the Prime Minister and her party.
And Steve, speaking of what we're seeing in the bond market, I was referencing earlier that Bloomberg report citing Chinese regulators advising financial institutions there to rein in their holdings of US Treasury bonds. Are you seeing any sign of that?
Not as such. I mean, it's hard to get the hard data. We're certainly not seeing a big, people really fleeing the bond market. I think we're going to need to see foreign participation in auctions as the Treasury calendar rolls along. I do think there's a lot to unpack here, because there's also concerns that, a Fed run by Kevin Warsh would try to reduce the balance sheet, but the bond market remains just basically mired around this sort of 420, 425 level on the 10-year. And while we did have some gyrations at the short end, when the JOLTS numbers came out about, possibly increasing possibly bringing forward the likelihood of the next cut into June from July. It's amazing how solid the long end has been, how little volatility there is compared to what we see in stocks. Bonds, it's almost as though they've outlawed volatility, particularly at the long end of the curve.
Steve, so much to watch at the moment. Thanks for getting us across it. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. We'll talk soon. Take care.
Let's now focus on the local markets. Now, we had that very impressive gain, pretty much wiping out the losses we saw on Friday. Yesterday, up 2%. So we are expecting to build on that when we get going. In just a couple of minutes, ASX 5 futures up 0.4%. Earnings season slowly getting underway. We've got a couple of results to get across, also some consumer confidence figures. We'll do that in just a couple of minutes. Stay with us.